Federal Reserve Chairman Ben Bernanke is firing back at criticism from home and abroad on the Fed's easy money policies. China raising its reserve requirements for banks by 50 basis points. For his take on what all of this means for the markets, we bring in Marc Faber. He is the editor and publisher of the Gloom, Boom, and Doom report, and he is joining us now on the phone from Chiang Mai in Thailand. Marc, thanks so much for joining us. As expected, China raising this reserve requirement 50 basis points, the fifth raise this year. You've said in the past that a property bubble in China could ruin China's growth rate. Do you feel like the Chinese government is decreasing that possibility by tightening?
No, I think we have already a property bubble, but it doesn't mean that the whole economy will go into recession. And I would add to it that even if there is a slowdown in China, it's a very large country like the U.S. was in the 19th century and still is today. So you can have some sectors of the economy going into recession and other sectors still expanding.
I want to read you a quote from a Morgan Stanley economist based in Hong Kong saying inflation is a real and meaningful threat to the Chinese economy. The risk of repeating experiences late 2007, first half of 2008, and he's talking about the surge in commodities prices, broad-based inflation. He says in the emerging markets, this is on the rise. Is this a dangerous situation?
Well, I think that inflation is a dangerous situation everywhere in the world, both for the poor people because they spend a higher percentage of their income on food and energy, and for the rich people whose cost of living are also going up very substantially. I mean, I think in general, the consumer price indices published by China and the U.S. do not reflect the real cost of living increases that a household in these economies has.
So is it worse in emerging markets, Marc? Worse in emerging markets than in the U.S. or Europe, for example?
Well, in emerging economies, it's worse in the sense that, say, if you have a per capita income in India and Vietnam of $1,000 a year, then food accounts for, say, 50% of your expenditures. So when food prices go up, then obviously you suffer.
So, Marc,
on the other hand, because in these economies, 70% of the population is employed in the agrarian economy. The agrarian sector does quite well.
But if the Chinese themselves are worried about a bubble to the point of tightening 5 times this year alone, I mean, should investors begin pulling assets out of China?
Not necessarily, because even they tightened, interest rates are still far below the true rate of inflation. And I talked to a lot of people in China. My view would be that inflation in China is running at around 10% per annum.
All right. We just heard from the Fed Chairman Ben Bernanke, and I know you have called the QE a huge money printing machine, many dollars of which you say are landing in emerging markets. What do you think of Bernanke's defense of QE2, and does it mean anything for the markets?
Well, I think that his defense has to be expected. He has to defend himself for the repeated mistakes he committed in the past. And all I would say is that basically the problem of the world is that the U.S. overconsumed and spent too much on consumption, which was then reflected by the growth in the trade and the current account deficit. And as can be expected, some countries didn't want their currencies to appreciate too much. And so we have this problem today at hand. And I think that China and the U.S. are on a collision course, both economically and politically.
Marc, we have about 20 seconds left. Earlier this month, you told us we're going to see a correction in the U.S. stock market. Do you still think so, and by what percentage and by when?
Well, I wished I would know, but I think that we had a rebound yesterday, but I don't think that the market will make a new high in the near term. Okay. And how far the correction will go, I don't know.
We have to leave it there, Marc. We thank you, as always, for your time.